What's up, investing legends? Today we welcome Jonathan Nurick to the program. Jonathan grew up around investing from a young age, learning public market fundamentals inside his family office's hedge fund. Over time, he began developing a unique investment philosophy, one built around long-term thinking and dividend growth. Jonathan's thesis became increasingly popular amongst his inner circle, which led him to co-found DivGro, a fund built around his effective long-term investment thesis. And in today's episode, we dive deep into the nuts and bolts of his thesis and how he's managed to outperform the index by identifying companies capable of growing their dividends at high rates for decades. We kick off the episode today with Jonathan's origin story and how his early exposure to hedge funds eventually led him to build a completely different long-term investing strategy. Later on, we dive into the dividend growth strategy behind DivGro, the psychology of staying invested through volatility, and why most investors fail, not because of what they buy, but because of how they behave. And to wrap up, Jonathan breaks down how he evaluates companies, why predictable businesses with strong installed bases win over time, and how investors can structure their mindset to capture long-term compounding. So, if you're looking for practical frameworks to think about long-term investing, dividend growth, and building wealth in the public markets through disciplined decision-making, this episode delivers perspective from someone managing capital with a long-term 30-year investment horizon. So, without further ado, everyone, let's welcome to the show, Jonathan Nurick.
Welcome to the Investing Secrets Podcast.
Jonathan, welcome to the vault.
Thank you, Danny. Great to be here.
Yeah, man. I'm stoked to have you on, man. And it is bright-eyed. You're calling in from down under, right? So you're like 9 a.m.
right.
over there. So you're drinking your morning coffee, and I'm like,
we're in the middle of
day.
summer, but it's pouring with rain.
Is it really? Oh man, yeah. What a bummer. Which part of Australia are you in, by the way?
We're in Sydney.
You're in Sydney. Okay. Awesome. Well, right. Just jumping off the bat here. You are co-founder of DivGro. DivGro is, for lack of a better term, a hedge fund. Yes. And you, have pretty lofty goals, 30x the fund in 30 years. So I'd love to hear kind of like the background and the history of like what started or like what prompted you to start DivGro and what's gotten you to this point.
Thank you. A lot to unpack there. I was lucky in a sense to grow up in a household where my father had founded a hedge fund business. All of my uncles worked in that hedge fund business. It was ultimately very successful, but I was very keen to learn and participate. And from a very young age, I was reading books they assigned to me, trading myself, investing myself. And after, graduating from university, spending some time in law firms, investment banks, it was time to move into our family office, which came about as the result of the successful sale of that hedge fund business. And after a few years of implementing our strategy in our family office, I noticed that while financial services, there are lots of participants, it feels like it's a well-served market, there were many families around us who kept saying, I really like the sound of what you're doing. I've been around various funds, various handholders, but I much prefer the sound of what you do. Please, can I allocate to you? And you hear that enough times and you think we're doing something special here where we're blending a financial skill set and a psychological, emotional skill set. And that really can serve people very well. And so we opened the fund. We opened DivGro on my 30th birthday. And the idea was to take a 30-year horizon, basically a career-long horizon, with a very lofty objective. But at the same time, by articulating that you're looking for a return over a 30-year horizon, you actually self-selected your investors. By telling them, we are not thinking about what's going to happen this week, this quarter, even this year. I mean, we're interested in what's going on this week, this quarter, this year, but we're really trying to optimize for that 30-year horizon. It's very different to the industry when you sit in most other hedge funds and it's really trying to optimize the quarter, or very long term would be a year.
So I would imagine, Jonathan, that the philosophies, right, like the trading philosophies and whatnot, are a lot different for a fund with a 30-year horizon as opposed to a fund with like a 3-year horizon, right? So what would you say are like the innate differences between the strategies and the philosophies that you have within the fund versus like those, like a, you know, like, think of like a more traditional hedge fund where you're thinking like, hey, you know, we got to hit it now. We got to hit pay dirt now. We got to hit it now, right? Like it's almost like a self-fulfilling prophecy. Like you're in it quickly, but like it's quick to rise, quick to fall sort of thing, right? So yours sounds like a much like longer term horizon, and philosophy.
Yeah, we're thinking about for our investors, basically for the next generation. And that means that from day one, what we try and do is build positive, better habits for the investor, because to get through that time frame, you need to make sure that you're mastering, one, the financial merits of what you invest in, but two, the emotional, psychological part of being an investor in those instruments, thinking over that long term, because the market will throw all sorts of things at you. We opened at the end of 2019 and 6 months later there was COVID. So it was a real test. And we are trying to blend these two critical things. The whole industry is just focused on one. Every investment book, the vast majority of, articles, media, they're talking about what to own, what instrument to own, why to own it now. And that's very important. That should never be understated. But if you look at the data, people struggle to stick with the program for a very long time. It doesn't matter whether that is a single stock, an ETF, a basket of ETFs. The holding periods are getting shorter and shorter and shorter and shorter. And we're trying, in a sense, to arbitrage this time scale using dividends and dividend feedback as a reinforcement mechanism to keep somebody with a constant signpost that's telling you directionally you're moving in the right direction. And by doing so, to keep you on track, invested in these wonderful companies, most of which will end up delivering excellent outcomes if you're able to stay the course.
What I believe I read that you're currently invested in 30 different companies, correct?
Yeah, that's right. We're always about 30.
Okay.
It's enough concentration that our ideas matter, but also a certain degree of diversification that if we make an error on one or two things, and we're not going to be perfect, we will still have a good outcome, and score accordingly on the things that matter.
When you're what goes into the assessment, right? When you're assessing like what companies to invest into, and obviously the strategy you mentioned before, rapid dividend growth. So I'm assuming like these companies have to provide dividends, right? That's probably one of probably one of the prerequisites, right, for investing in there. So walk us through the frame that you assess every company and try and decide like who you want to invest into.
Okay, let's start one step before that. Back in the 1950s and early 60s, there was a professor at MIT by the name of Myron Gordon, and his research team ultimately went on to win a Nobel Prize in economics for their later work. But what him and his team were trying to do was identify what variables were most useful as a proxy to try and forecast share prices. And what they found was a few interesting insights about dividends. They found one, that companies that pay dividends as a category outperform those that don't. There are outliers, obviously, on both sides, but as a category, you were better served. The second point was that those companies that increased their dividends outperformed simple dividend payers. It makes sense because if you're able to increase your dividend, the right things are happening up the chain. Your sales are likely to be going up. Your margins are probably going up. Your profits are certainly going up, because otherwise you don't have the financial wherewithal to raise these dividends. Then they found that the faster the rate of dividend change, positive change, the better the companies performed out of those cohorts. And ultimately, they sort of canonized this model called the Gordon growth model, the dividend discount model, which stipulates that over time and at points in time, the sustained rate of change in the dividend is expected to be reflected in the same sustained rate of change in the price. So to put that really simply, if you can find a company and you expect the dividend to go up at 10% a year for a very long time frame, over time and at points in time, you should expect that share price to rise at roughly the same rate. And they do. Now, it's not true at every point in time, because sometimes the market is very concerned about a macro thing, whether it's a currency thing, a geopolitical thing, an AI thing, a virus. But over time, these things coalesce. And we looked at that and we thought, what if we were able to identify one step further the variables that would educate which companies can grow their dividends the fastest? And that's where we target. We are looking to identify companies that can raise their dividend at a very healthy double-digit rate every year for a very long time. Now, we use about 120 filters. Some might be fairly obvious, like sales growth and market positioning and competitive dynamics, and others might be a little bit off the beaten track. Things like charitable giving is very interesting to us because we've been able to identify correlations between charitable giving and dividends, and then there's one between dividends and price, as Gordon demonstrated. And if you're able to identify these companies that grow their dividends at a high rate over time, there's a psychological aspect, a real psychological unlock here. Because every quarter when your company pays its dividend and it's higher by a meaningful amount than the same quarter the year before, that's like a signpost, a marker that you're on the right track. The share price will generally follow that, but sometimes deviate. Over time, the two synchronize. But whereas the marketplace gives you all sorts of difficult feedback to work with, the dividend is keeping you on track because you have this real tactile feedback, in cash piece of information that helps you stay the course and get to that ultimate outcome where the dividend has compounded, ideally for decades, at a very high rate, driving the price at roughly the same rate.
These 120 filters that you use, proprietary, internal, right, that you've kind of built out to decide, right, which companies to invest into. I'm curious because, look, I'm a real estate guy, right? And I make no mistake about it when asked, public equities or real estate, I would say real estate 100 times out of 100. That being said, the strategies that you use are, or I should just say your business model is a lot different than just like, hey, let's put this into the S&P, right? Or like, let's just go, Vanguard and call it a day, right? So, there's a big difference between index fund and a hedge fund. And, what would you say, aside from like the close monitoring and the obviously like the mathematical equations that you've kind of got in the back end to analyze these companies, but like, what would you say are the key differences between, just an average investor investing into, like, say, the index, right, versus putting money in with DivGro?
Firstly, index funds, high quality index funds, can be very, very good for an investor if they're able to stay the course. Over time, you mentioned the S&P 500 or various Vanguard funds, they have delivered very good outcomes. The only problem is that as an investor, people don't necessarily have a feedback that is separate to the price. So you watch the price go up, you probably feel good. You watch the price goes down, you probably feel worse. Yeah. And each one of us, being human, is somewhere along the continuum of emotional resilience when it comes to how much we can tolerate on the fear or the greed side. Warren Buffett is on the one extreme, somebody else is on the other extreme, and you and I are probably somewhere in the middle along that continuum. And what we're trying to do is up-level people using this dividend-based feedback. Now, like I said, index products can be great as long as we can stay with them. But the data suggests that many people struggle to hold them for long. It's interesting that you're a real estate investor because in a sense, we're trying to bring a real estate mindset to public equities. In real estate, you don't have a moving price on a given asset, right? Or whether it's a building or an industrial shed or something like that. And once you acquire it, you can't really go and sell it the next day because there's a lot of friction. You have to advertise, find a broker, find a buyer, renegotiate leases, etc.
Sure.
So you become much more fundamentally oriented. Is my rent being paid? What are the prospects for the rent? What might I be able to do to improve that rental profile, which might be improving the tenant mix, improving the physical structure, maybe other kind of adjacencies, or maybe it's on the financing side. Try and improve. But really what I'm trying to do is boost the rent and ideally get a multiplier on that rent. Now, in public equities, the behavior ideally is the same. You're a participant in a business, and what you're trying to do is employ strategies, build new products, hire good people, distribute them well so that your profits can rise at a healthy rate for a long time. It just so happens there's a share price that's moving every second of the day.
Right.
And that's very destabilizing to people. So by using these dividend-based metrics as feedback, almost like every week or every month, did you receive the rent? Is it higher than this time last year? How much higher is it than this time last year? One can build better habits such that you're able to withstand the ups and downs and be more attuned like a real estate investor. When you buy a property, you're probably not thinking about selling it tomorrow. In fact, you'll probably be behind because of the frictional costs. And we're trying to bring a similar mentality to public equity investing. That's part of why we're talking about a 30x30 objective. If we can identify a company that will grow its dividend in the order of 30x over 30 years, that implies a rate in the order of 12% per year. Most of our companies have been able to sustain that for a long time. We think they'll be able to do it in the future. Some might even accelerate. And those that won't be able to keep pace, we should be able to pick that up in advance, given our 120 metric filters, and weed them out and replace them with things that have a brighter future. And use this dividend feedback mechanism, which is easy to understand. A lot of other financial metrics might be more complicated or more adjusted, but dividends are paid in cash. They're a single number. A professional like yourself can understand it, but I think also a novice can understand what a dividend is and what it means when it rises, and keep a person on track so that they look back almost like a building. Oh, the rent is now 10x. It's probably worth roughly 10x.
Makes sense. So let's talk about the dividend feedback loop a little bit more because you keep coming back to it and I find it interesting. So I'm assuming just like every fund manager out there, that feedback is going to dictate whether you decide to hold, sell off, or buy more, right? So how frequently is are these, this doesn't sound like high frequency trading to me, right, Jonathan? So it doesn't sound like, hey, you guys are making thousands of trades a day and arbitraging and riding that emotional roller coaster. It sounds like it's more of like hey, we have a very regimented process, this feedback loop that we pay attention to. And these are the things that we look for that, allow us to make decisions. But it sounds like those decisions are made a lot more, sporadically, like a high frequency trader. So walk me through those, the decision-making process there that the feedback loop kind of like gives or allows you to kind of like decide when to buy more, sell off, kind of stay the course, etc.
So you're right that we are not making thousands of trades every day. We are constantly looking and testing whether what we own are things that we want to continue to own. And on average, our turnover is about 10% a year, more or less, which implies a 10-year holding period on average. Now, if we conclude that something will not be able to maintain its dividend growth rate over the long term at a high rate anymore, then we will part ways. But we start by distilling the investable universe into a library of companies that meet our criteria. So to be able to grow your dividend at a high rate and every year, you need to be a very predictable business. You need to have a product or a service, ideally many products and services, that can't be switched off and that don't require a very slow process of deciding whether or not to buy it or need to be rejustified all the time. So we think about a concept of an installed base of products, services. There might sometimes be software that a business or a person needs to start their day. That makes it much more predictable. So on a physical product side, there might be a continuous glucose monitor that a diabetic person you might have seen wears on the back of their arm. To that person, it's an incredibly important product, literally dictating their health. It's very unlikely to go away. So as a leader in that space, your visibility into the future is much more predictable than a company that basically has to start their day or their quarter or their year from the beginning, from one, selling new stuff. Once the installed base is in place, we're also looking at the degree to which a company can grow it, can add more products, add more services, ideally become more efficient and increase its margins over time, all of which will translate into profitability. So if we invert the question, what can we not own? We can't own things that are very erratic or that are very sensitive to things outside of their control in a fundamental aspect, not necessarily in terms of share price. So we don't own things where a price of something in the marketplace dictates their profitability. We don't own resources, minerals, metals, etc., because we aren't skilled at trying to guess what the price of copper will be next week, next year, in 10 years' time. We don't do things that are logistics because the price of shipping, a container shipping can go up 10 times and then decline by 90%. And that will dictate your profitability. Same with oil or airline seats. So we don't do any of that thing. We prefer installed base of software, where a business needs a certain type of software to run every day. It's extremely critical. They're very unlikely to replace it. And as incumbent, I can keep building improvements, more modules, ideally at a higher price. And I have visibility. Now, if I have visibility, it allows me to invest with better visibility behind improving my business and make clearer determinations around my dividend policy such that I can share part of my rising profitability with my investors, ideally for a very long time, and signal to them that the future is really bright. Importantly, we like companies that while they pay a dividend, they reinvest the majority of what they earn. That really they're thinking about growth, that they have good growth prospects, and they share a small part of what they earn. One, to build a bond with their long-term shareholders. We believe ultimately companies get the shareholders they deserve. And two, by getting that feedback, the investors are able to look at the company fundamentally and say, if I distill this down, if I do all my work and I get to a one number proxy at the bottom, how is that moving? Is that moving in the right direction? That is helpful at keeping the investor grounded, keeping the investor along the course to get the ultimate compounding, instead of at the end of every day, week, quarter, seeing some kind of news alert that may or may not actually influence this company fundamentally, but might shift the price temporarily, and choosing to be in or out on that basis all the time.
I think that's my biggest gripe with public equities, Jonathan, is that it's so volatile and it's very influenceable, but by external forces, someone else brought it up earlier today. It's like, a tsunami hits in Japan, and then like the share prices of American stocks go down. It's like the two are not correlated whatsoever. And then, but now the price is suddenly like, $4, $5, $6 lower. And really the people who win are the larger institutional funds that have the inside beat, right? So they're the ones making the money off the backs of the average investor, right? So, but to your point, what it sounds like, and correct me if I'm wrong, but what it sounds like is you're taking a much different approach, a much more, what's the best word to put it? My takeaway is that your approach is more disciplined in the sense that you're not reacting to lagging or like uncorollary metrics, like non-corollary metrics, right? Which sounds like you've determined that dividend prices are much more corollary to the long-term trajectory of a company's success versus the individual stocks or like the individual company's like stock price on any given day. Is that what I'm inferring then? Is like you're saying dividend growth is much more indicative of a company's success versus like, hey, it went up $10 today and it came down $20 the other day. And then, just riding this roller coaster of stock pricing that really is more reactionary than anything else.
It's a good observation, but just one note on this idea of volatility. Volatility can be a very favorable thing because if you invest in businesses that you understand, and we only want to be in businesses that we think we are have a very strong understanding, then when there is volatility that based on your understanding has little or nothing to do with the company's long-term prospects, but the share price has temporarily given you an opportunity, you can buy something that's mispriced, and ideally you can buy a lot of it because in great companies, you don't often get that opportunity. And recently in some of the software related names, we've very much taken that opportunity. People are very concerned currently about how AI interrelates with the prospects of software companies. We know certain segments of the software world very well, and we have added very meaningfully to some names on this sell-off. Now, what we did when we opened DivGro, we borrowed some of the thinking that Professor Gordon at MIT had developed in that dividend growth model, but we added an element to that. We added psychology. What we decided to do was liaise with leading academic, practicing clinical psychologists, psychiatrists, thinkers in the space to build a communication system. And we settled upon a weekly 1 to 2 minute bite-sized piece of information. Comes at exactly the same time every week. People are welcome to join on our website. And it tells you not the latest movement in the price, not the macro goings on, but what is happening to the dividends of our companies. So this week it will say that the dividends from Home Depot, which we own, and Danaher, which we own, increased in the case of Danaher by a very big increment. Then we will also write 2 or 3 sentences about what makes these companies interesting, in our view special, and likely to be able to, over time, keep compounding their dividend at a very attractive rate. Even if at one point in time the dividend may accelerate or slightly decelerate, if we believe that it can continue at a very high pace for a very long time, we will continue. Now, in any given week, that 1 or 2 minute read might not seem like much, but it creates an improved habit. It's a little bit like going to the gym. Going to the gym once with the trainer is not going to do that much. You'll probably feel sore after that. But if you're trying to develop habits around getting fitter, losing weight, being able to continue on a journey in a manageable process with the right increments, with the right feedback system, sets you on the right path that you can actually stick with. So instead of sending very long pieces of information, detailed analysis, difficult metrics for the average investor to follow, we distill this down into one proxy. And we think that builds better habits. Ultimately, our success is up to us, but the big unlock is in how do we synchronize our behavior with our investments? And we think that by identifying dividend growth and articulating that in the right way, it sets investors on the right path to stay the course in these wonderful companies and get those long-term outcomes that otherwise they would sort of capitulate at the wrong time. Just as you say, when the wrong news article hits them at the wrong time, and they'll simply sell.
Right. Interesting. So, let's dive. I want to explore the psychology aspect a little bit more because you have brought that up before. Explain to me, is this more of like an investor relations approach, or is this more of like a understanding psychology to make better decisions when it comes to which companies and whatnot to invest into? Which one, or is it like a combination of the two? I'm wondering.
It's both. Part of our selection criteria in companies, in addition to what we discussed already, which is very, very predictable, critical businesses, we actually prefer things that aren't constantly in the public eye, always drawing attention to themselves. So the tiebreaker is in favor of the less in the news. So some of our favorite holdings are distributors of air conditioning components, pool equipment and pumps and things like that. Components that go into the manufacturing supply chain of various medications. Things that are very unlikely to captivate public attention and therefore kind of pull on the heartstrings in both directions. So it's part of the selection criteria, but it's also part of the communication. We try and get people to understand what we own and why we own it in a simple measure in these bite-sized installments, so that when inevitably the price falls for a reason which may or may not be sound, and that's our job to assess whether it's a good or bad reason, they're able to stay the course rather than capitulating. It is not that somebody needs the single best stock to succeed. In fact, they're relatively unlikely to find the single best holding. We think that everybody is spending all of their time trying to optimize for the what to hold, but they haven't turned their mind into how to hold it. And to be successful in investing in public instruments, which are tradable, you need to make sure that you are properly calibrated for both. Owning the right kind of thing and the right kind of thing with the right kind of feedback to keep you along that journey.
Yeah. Well, it's interesting that you say out of the public eye. I think that makes a lot of sense, because the more in the public eye you are, the more, I feel like the more volatility you can kind of bring into the equation, right? Like I think of, look, Starbucks a couple of years ago, right? Like they said, they did a couple things, said a couple things, and all of a sudden, like, they've got this huge boycott. And I mean, gosh, like, it's just like, very reactionary, kind of behavior, right? And then the share prices tank, and right. So it's just like, I can understand. That makes a lot of sense to me. Or even you got like a polarizing, CEO figure like Elon, right? And then all of a sudden, share prices react accordingly as well. So it sounds like your philosophy is also, so is that more or less the case then, Jonathan? It's like, hey, out of the public eye, the better, so that like it's the fundamentals stay intact more when you're out of the court of public opinion, is what it sounds like to me.
Look, the financial markets do have lots of participants with lots of resources and lots of clever people there who are working very hard. So these companies do have analysts and investors and institutions that are following them. So the price discovery most of the time should be roughly accurate. But from time to time, there's a dislocation. We do prefer things that are more steady state, and therefore are less likely to have those issues. Though once upon a time we did own Starbucks. We felt there was significant change in the business several years ago, and that's why we don't own it anymore. It became much less predictable to us. But the quick service restaurant space is a very interesting place for dividend growth methodologies, because they're very predictable in terms of people's consumption, in terms of the traffic through them, in terms of the franchise fees. And we're still participants in that space. We don't own Starbucks anymore. And you mentioned Elon Musk, and we have to kind of marvel at the things he's been able to achieve and the great success 100%. Of those companies and how they've shifted technology forwards. But that's not for us. It's a little bit too unpredictable for us. So we prefer things that are easier for us to understand, and people can do wonderfully in his companies and have, but we prefer things that are more predictable, easier for us to get on top of. And where there's a dividend behavior, what we call a dividend staircase, where if you actually chart the dividend trajectory of our companies, what you will see is literally a staircase. You'll have 4 payments of an amount each quarter, and then a jump up, and then 4 more payments though, and then a jump up. And if you chart that, it looks like a staircase up and to the right. And the share price, if you chart it on top, you will find it looks a little bit like a roller coaster, traversing the same directional move. They'll typically end up or cross at various points, the two charts, but one is a much more challenging emotional ride, and the other one, it's basically up and to the right. And companies that adhere to that methodology usually also run themselves accordingly. They move in more predictable, in a more predictable fashion. And we think that lends itself to a much easier or more tolerable, more palatable investment journey. The experience is a little bit more linear for the investor. Not perfectly linear. Share prices are still volatile or erratic over the short term, but the business is a little bit more linear. And the experience for the investor can hopefully be more controlled in terms of not having those like end extreme of extreme fear, extreme greed, because it's significant changes all the time.
Yeah, that makes sense to me. One thing that you said there that resonates with me and kind of touches on some of the concern that I have with the current investment philosophies of most Americans. I don't know if you know this, Jonathan. Well, you probably do. But the average American, and I say American because I don't know Australia, right? Like I'm just going off the country that I'm in. I'm sure you know Australia statistics, but the average American has 95% of their investable assets tied up into public equities. And you know, the thought process of the rationale is, well, you know, we want to invest in public equities because alternative investments are things that we don't understand, right? Like we don't understand like, oh yeah, I don't want to invest into real estate because I don't understand real estate, or I don't want to invest into crypto because I don't understand crypto, whatever, right? Well, you just touched on something right there, which is, you know, you don't want to invest into companies or technologies or things that you don't understand. And I think the reality is that most people invest into the stock market, into public equities, understanding the marketing of Wall Street and public equities, but not understanding the businesses that they're investing into. Right. So it's my argument's like, you don't understand what you're investing into with public markets as well. You've been spoon fed the philosophies, the marketing, right? The marketing philosophies, of Wall Street, right? And that's what we've been spoon fed here in America. I don't know how it is over there in Australia. I have to imagine it's fairly similar, in terms of like the indoctrination of an entire generation. So like, at what point do we break the cycle and like get people to invest into things that they understand? Because like that's my thing. It's like, hey, like invest into things that you understand, and don't trick yourself into thinking that you understand the public markets, because you actually don't. You don't understand these companies. Do you read their financials? Good. I guarantee you most people don't. Right. So anyways, I'll get off my soapbox and let you respond to that, but that's my take on it.
It's funny you say read the financials. Based on what you see out there, people will spend weeks analyzing, what washing machine to get as a replacement if theirs broke down, but 15 minutes in the back of a taxi to decide what stock to buy. But in Australia, people actually love real estate. It's part and parcel of almost the Australian investment psyche, to participate in real estate. So you'll probably love it here, to come and be an investor here. But I think there's merit to every different asset class, as long as it meets the requirements for the investor and the investor can understand what they're in. It's really part of why we try and transmit this information to our investors, that they really understand, one, what they're invested in. Mm-hmm. And some of these companies are very easy to explain what that is. A distributor for pool components, that's not a complicated business to explain. Others might be a little bit harder to explain, and we try to do a very good job of that. And then second, for people to understand, what is the objective? What are you trying to see that will make you either right or wrong, so that you are on the right experiential curve and ultimately get the success that you're looking for from a compounding standpoint. Now, people in Australia seem to like real estate because they think it's very understandable. There isn't all the media circus around it, as often happens in public equities. But it reminds me, your question reminds me, say, of Peter Lynch, one of the great investors of the 80s and 90s, who used to say, go to the mall and look at the businesses you understand, and everybody can understand certain things. Everybody works in something and therefore has a certain element of expertise somewhere. You don't have to be in 1,000 different things. You only have to be in a handful of things that you understand that are really good, that you'll be able to stay the course, and you'll have a good outcome.
Yep.
But people really like chasing for the exotic, rather than sticking to what they understand, and we'll try and up-level that understanding.
Yeah, and I think to piggyback off of that, Jonathan, that is the power of building a relationship with someone like yourself, right? Is that like, look, if you're a busy, high income earner and you're I use this a lot, but like if you're like a surgeon, right? Or like a physician, man, your whole life is dedicated to helping people and worrying about people's health. Like most of these individuals just do not have the time, the bandwidth, the energy, right? To fully understand, what they're invested into. And that's where like building a relationship with someone like yourself makes a lot of sense, because they're in a sense trusting you to be able to make, to do the hard work, right? Which is research, do all these things. And then at the end of the day, like, sure, you can transfer some of that knowledge over to them, but like you'll transfer what they need to know. And the rest of it's just like, hey, like they're putting the money in your hands. So like you go do it, Jonathan, you do the hard work, and I trust you to do that. I think where, and that makes a lot more sense than just like, financial advisor who is just kind of putting you into some cookie cutter, funds and whatnot. Like it's not the same thing, right? It's really not the same thing, where they're hand selecting you because they've built a level of trust with you to go out there and do the hard work, right? So that's the power, right, of working with someone like yourself.
So a few interesting points. One, somebody in our team will meet every new investor so that we can get to know them, build that trust, build that relationship. and actually select our investors for those who have the right kind of mindset. We don't want somebody who's thinking about, allocating the money to something in 6 months' time, because we're really thinking long term. But it's funny you mention a surgeon. We write letters from time to time to our investors, long form letters where we articulate our thinking on a particular area. And we wrote about a professor that we know who was on the original advisory board of Intuitive Surgical. Now, we don't own Intuitive Surgical, and for context, Intuitive Surgical is one of the 2 giant winners in robotic surgery, and it's been a phenomenal success story. We own Stryker, a competitor. Which has also been a phenomenal success story. And the reason behind that is that Stryker has been able to grow their dividend at a healthy rate for a very long time. Intuitive Surgical does not pay dividends, but is a wonderful business. But this medical professor was involved in the company from day one and was entitled to a very significant entitlement to stock in the company. And as the share price continued on its course upwards, from time to time, he simply couldn't tolerate the gap or the disconnect between the fundamental progress of the business, which was outstanding, and the share price that every so often would fall precipitously for reasons that he just couldn't comprehend, because the business is going amazingly. And ultimately, he sold his entire stake. Don't get me wrong, he made quite a lot of money, but he left on the table hundreds of millions of dollars because this was such a success. But it was, even though he understood what it was, he was unable to bridge the gap between the share price, which was erratic, and the fundamental progress of the business. So sometimes, even in things that we understand, if we haven't thought in advance about our emotional makeup and what kind of feedback we're going to need to stay the course, we may still not be able to get the ultimate outcome. And that's an extreme case where there was temporary disconnects and it was simply too much for a person to bear. So if a different company, say, had a dividend, and in the case of Stryker, a competitor which we do own, does and has had a rising dividend all the time, our contention is that that little piece of feedback, separate from the share prices ultimately do follow the dividends over time and at points in time, a person, an investor, is better equipped to stay the course for that ultimate successful outcome.
Yeah. No, that makes a lot of sense to me. Man, this has been a great conversation, Jonathan. My wheels are spinning right now. And there's like so many questions that I want to ask you. And then I'm also looking at the time and I'm like, man, we're running up on time. So there's that. But, before I let you go, there was one thing that I wanted to kind of pick your brain on here, since you're so in tune with public markets in general. And, obviously we've been hit with this massive wave of artificial intelligence, and it's become more and more commonplace now for AI to make things easier, and obviously like people are getting replaced, etc. And I don't know. There's this Substack article that I'm like halfway through right now. Have you read this? It's like the 2028 AI, like global AI crisis.
Yes, I've read it.
Okay, yeah.
I've read it.
I'm about halfway through that one. I think, look, at the end of the day, it's fiction. I understand it's predictive fiction, but it's fiction nonetheless. Interesting perspective. And I think that there's perhaps some merit to it. So where do you see AI kind of leading us in the next several years from an investor standpoint? Like, what are the things that we should be looking out for? Obviously, there are some sectors that are bound to be positively influenced by AI, but is the positive influence everlasting, or is it like a flash in the pan that will eventually lead to chaos?
Look, I've read that article, and that article resonated very strongly in the marketplace and really dinged, at least temporarily, the price of some of the things that they mentioned, though some have since recovered. But part of why we like installed bases, predictable businesses of things that are really critical, of things that grow their dividends all the time, one, they've been around for a long time and they've kind of shown their strength. And that means that they're very difficult to replace. They're really critical. So they've been through many technological waves or changes over time. Some of our companies date all the way back to the 1800s, and they are still around and still flourishing and stronger than ever. And they're not sitting still. They're trying very hard to utilize AI where they can. In most technological waves, the outcome is very difficult to guess in advance, and it's usually very significant but different to the first guesses. So I found their article very interesting. There might be elements that do go that way. I mean, it's a pretty catastrophic outcome that they describe. So let's hope that kind of future is avoided. But things that are inherently unpredictable, it's often not worth trying too hard to be specific. Our view is that however AI comes to pass, useful, less useful, world-changing or not, in the case of things like air conditioning, people will probably continue to want to live and work in air-conditioned spaces. Therefore, pumps, compressors, control panels will roughly continue as they are. And that's part of why we avoid really cutting-edge technology. Those of our companies that are influenced by AI, they're making very good early implementation, but we will have to see how things go. For the time being, the products and services that they're infusing AI into are selling very well. They're natural extensions of what they do. So some of these companies used to do things manually, then they did things on computers, then through the internet age, then they moved to a delivery mechanism, maybe over the internet, and now this might be the next iteration, but it's a bit early. We watch and we wait and we think, and we will develop accordingly.
Yeah, and I guess my take on it is too is that you trust your system and you trust your models to basically guide you down the right path from an investment standpoint. Right? So you're like, hey, you feel like these models will be able to guide you the right way because at the end of the day, from what I gather, right, like your model is based on dividend growth, and however those dividends are affected by AI, you'll be able to spot and make the adjustments that are necessary. That's what it sounds like.
That's right.
To me.
And we touched on this earlier. You don't have to be in every single thing to do well.
Right.
One can participate in real estate, which may or may not tangentially be somehow involved with AI over time, but somebody can be perfectly successful in real estate. And the same is true in public markets. Some companies at the forefront of AI, others are somewhere up downstream, others so far not much involvement, but there are lots of different areas that one can be successful. If you have a model or mechanism that works and you implement it well, and then you curate the right kind of feedback, you have a good recipe. And that's where we think we are.
Jonathan, if the people want to find you at home and learn more about DivGro, etc., where can they do that?
DivGro.com.au. We publish all of our letters there. We will publish podcasts like this there. People are welcome to join our weekly email communication, which is a Friday morning thing in Australia. So it's probably a Thursday evening for many of your listeners. People are welcome to come and read and listen and follow what we're up to.
Love it, man. And we'll have that linked up in the description below. Jonathan, you are not allowed to leave the vault until you leave the audience with one final investing secret. Take it away.
Master your mindset at the same time as trying to master what you're going to own. Figure out what you can tolerate, because it's going to come, whether it was COVID or the next thing. And in doing so, be very thoughtful about the feedback that you collect, who you're willing to listen to, what subjects you're willing to listen to them on, what news media you're going to consume, what other kind of media you're going to consume, because it can influence you in lots of different directions. But if you were thoughtful about what methodology you're going to use for investing and made sure that that's well calibrated with the type of person you are, everybody's somewhere, like we said, on the continuum of emotional resilience when it comes to investing, and you've curated your feedback appropriately, you've set yourself in the right direction for a higher degree of likelihood of success.
Yeah, I know. I love that, man. It's very tangential to there's a Gary Vee quote that I really love. I haven't watched any of his videos in years, but do you know Gary Vee? Are you familiar with? Yeah. Okay, so
I'm familiar with him.
Yeah, so he said something many years ago. He's like, you need to make sure that your actions are in alignment with your ambition, right? And so it's tangentially related, because you're like, hey, your mindset, right, is your ambition, right? It's like, hey, these are the goals that we have. This is the mindset that we have. We need to make sure that like the actions are in alignment, and make sure that the mindset's there, right? The ambition is there, and that the actions kind of work towards that, and don't let any of the noise get in the way, right? And so in a lot of ways it's tangentially related, but, yeah, man, I could not agree more. And I really appreciate you stopping by. Look forward to maybe having you on again in a little bit, and seeing what the growth has been like for DivGro, rooting for your success, man. And looking forward to subscribing to your newsletter. I think I could learn a lot from it too.
Sounds good. Awesome, Danny. Thank you so much for having me.